The relationship between the United States and China has long been one of the most consequential and complicated in the global economy. As the world's two largest economies, their policies and disputes shape not only bilateral trade, but also the stability of the global financial system. This week, Washington and Beijing narrowly avoided a significant escalation in their trade war by extending their fragile truce for another 90 days. Just hours before new rounds of tariff hikes were due to take effect, U.S. President Donald Trump signed an executive order pausing the increase of American tariffs on Chinese imports, while Beijing reciprocated with a parallel announcement. The agreement means that the United States will keep its tariffs on Chinese imports at 30%, while China will continue its 10% levy on American goods. Although this avoids an immediate surge in duties, Washington had threatened rates as high as 145%, while Beijing had floated up to 125%. It only postpones a deeper reckoning between the two powers. The pause buys negotiators more time to address structural issues that have fueled the dispute for years. At the core of the disagreement is America's vast trade deficit with China, which exceeded $300 billion in 2024, the largest imbalance Washington has with any trading partner. U.S. Officials accuse Beijing of engaging in unfair practices such as restricting market access, subsidizing domestic industries, and benefiting disproportionately from global supply chains, particularly in sensitive sectors like semiconductors and rare earth minerals. The White House has stressed that future talks must include commitments from China to purchase more American goods, open its markets to U.S. exporters, and address both national security and economic concerns, including technology transfers and intellectual property protections. Beijing, meanwhile, has sought to frame the extension as an opportunity for win-win cooperation. A spokesperson from the Chinese embassy in Washington emphasized that confrontation and suppression will only damage both economies, whereas mutual respect and compromise can help maintain global stability. China has specifically called on the U.S. to lift what it describes as unreasonable trade restrictions, which it argues harm companies on both sides and threaten critical sectors like semiconductor production. This is especially important given that China's access to advanced technologies, including chips from American companies such as AMD and Nvidia, has become a flashpoint in the broader geopolitical rivalry. Recently, Trump allowed limited exports of such chips to China in exchange for revenue-sharing agreements with the U.S. government, a move criticized by some analysts as an unprecedented form of economic leverage. Despite the temporary pause, uncertainty continues to weigh heavily on businesses in both countries. Small and medium-sized enterprises, in particular, remain vulnerable as they cannot easily adjust to sudden tariff changes. One American entrepreneur noted that planning for the future has become nearly impossible when tariff rates can fluctuate overnight depending on political decisions. This unpredictability adds to concerns about inflationary pressures, as higher import costs often translate into higher consumer prices. Indeed, even without fresh tariff hikes, U.S. China trade flows have already suffered. Imports of Chinese goods into the U.S. fell by nearly half in June compared with the same month in 2024, while American exports to China dropped around 20% in the first half of this year. The truce also highlights how trade disputes are increasingly intertwined with geopolitical competition. Alongside tariffs, Washington and Beijing remain at odds over issues such as China's purchases of Russian oil, its dominance in rare earth minerals, and the future of major tech platforms like TikTok. The Biden administration had previously sought to limit China's access to advanced technologies, citing national security, while Trump's return to the White House has revived tariffs as a primary tool of economic statecraft. These moves reflect a broader bipartisan consensus in Washington that China poses a strategic challenge, though the methods of addressing it vary. For China, the stakes are equally high. The slowdown in its export-driven economy, combined with rising domestic pressures, makes stability in trade relations with the U.S. crucial, yet Beijing is also unwilling to be seen as conceding too much ground, especially when its leadership is emphasizing national strength and resilience in the face of foreign pressure. As such, the 90-day extension should be seen less as a breakthrough and more as a fragile pause in a long-running contest. It provides breathing room, but it does not resolve the fundamental issues at stake. If anything, it underscores the delicate balance between economic pragmatism and political rivalry that defines U.S. China relations today. In short, while the truce may temporarily avert another escalation, the underlying tensions remain unresolved. The outcome of the upcoming negotiations will determine not only the future of bilateral trade, but also the broader trajectory of globalization, supply chains, and the stability of the global economy. Businesses, policymakers, and ordinary citizens across the world have a vested interest in how these two superpowers manage their differences, as the consequences extend far beyond their own borders. Temporary relief, not resolution. The 90-day extension of the U.S. China trade truce has certainly prevented an immediate escalation, but it is best understood as a pause rather than a solution to the deeper issues fueling tensions between the two nations. On the surface, the decision to hold tariffs at current levels, 30% on Chinese goods entering the United States and 10% on American exports to China, offers temporary stability for businesses and markets that were bracing for higher costs. Yet, beneath this calm lies a much larger set of unresolved disputes. The U.S. government has long argued that China's economic rise has been built on practices it considers unfair, including restricted access to Chinese markets, subsidies for domestic industries, and policies that allegedly pressure foreign companies into transferring technology. These structural grievances are not issues that can be settled in a few weeks of negotiations. They reflect fundamentally different economic models and competing visions of how global trade should work. From the American perspective, tariffs are a tool to correct what it sees as a massive imbalance, with a $300 billion trade deficit serving as evidence of systemic unfairness. For China, however, agreeing to sweeping concessions would not only hurt its economic competitiveness, but also undermine its sovereignty and development strategy. Beijing prefers to frame the situation as one where cooperation and compromise can produce mutual benefit, rejecting the U.S. narrative of exploitation. The gap between these positions means that the truce is less about resolving disputes and more about buying time, preventing a sudden shock to the global economy while both sides prepare for a longer contest. In essence, the temporary relief masks the fact that the underlying issues remain as contentious as ever, ensuring that the risk of renewed escalation will continue to hang over future negotiations. Economic uncertainty for businesses on both sides of the Pacific, the extension of the trade truce offers little reassurance because the underlying uncertainty remains unchanged. Companies, particularly small and medium-sized enterprises, cannot easily adjust to the constant back-and forth of tariff announcements and suspensions. Large corporations with diversified supply chains and deeper financial reserves may have more resilience, but smaller firms are often left struggling to predict their costs, set prices, and make long-term investment decisions. When tariffs fluctuate or remain under threat of sudden increases, business owners are left in limbo. As one American entrepreneur explained, there is simply no way to plan when the rules can shift overnight depending on the political climate. This uncertainty does not just affect corporate strategy, it directly impacts workers, suppliers, and consumers who rely on stable trade flows. Many companies are reluctant to invest in expansion or innovation when the possibility of new tariffs could quickly erode profit margins. The uncertainty also influences global supply chains as businesses look for alternative partners or shift production to third countries to hedge against risks. However, such restructuring is costly and time-consuming, often leading to higher prices for consumers. Even now, data shows a significant decline in trade volumes. U.S. imports of Chinese goods have nearly halved compared with last year, while American exports to China have dropped by about 20% in the same period. These figures illustrate how the mere threat of tariffs has already slowed commerce, regardless of whether new duties are implemented. The longer uncertainty persists, the more businesses will adapt by decoupling supply chains, which could fundamentally reshape global trade. For now, the truce merely prolongs this state of hesitation, leaving firms unable to plan confidently for the future. Geopolitics behind trade. The U.S. China trade conflict is far more complex than a simple disagreement over tariffs. It is deeply tied to broader geopolitical competition that touches on security, technology, and global influence. While tariffs grab the headlines, they are only one weapon in a much larger contest. At the heart of the dispute are sensitive sectors such as semiconductors, rare earth minerals, and digital platforms, all of which are strategically vital in the 21st century economy. The United States has expressed concerns that China's growing dominance in critical resources like rare earths, combined with its efforts to acquire advanced technologies, poses both an economic and a national security challenge. For example, Washington has placed restrictions on the export of high-end chips and related technologies to China, arguing that they could strengthen Beijing's military and surveillance capabilities. Although some restrictions were recently relaxed under Trump in exchange for revenue-sharing arrangements from American firms such as AMD and Nvidia, critics argue this reflects how trade disputes increasingly blur the line between economics and security. The case of TikTok further highlights this intersection. Washington has pushed for the app's separation from its Chinese parent company ByteDance, citing data security risks, while Beijing resists what it sees as political interference in its tech industry. These disputes show that negotiations are not just about balancing trade deficits, but about shaping the future of technological leadership and global economic governance. The geopolitical dimension makes compromise harder, as concessions can be portrayed domestically as signs of weakness or vulnerability. As a result, trade talks become entangled with broader questions of national power, making it unlikely that either side will easily retreat. This means that every tariff decision is ultimately a reflection of deeper strategic rivalry, not merely economic calculation. Global impact of U.S. China rivalry. The rivalry between the United States and China is not confined to their own borders. It reverberates across the entire global economy, reshaping trade flows, supply chains, and growth prospects worldwide. Because they are the world's two largest economies, any disruption in their relationship creates ripple effects that impact countries on every continent. When tariffs rise, global markets experience volatility, commodity prices can swing sharply, and businesses dependent on integrated supply chains face higher costs. For example, many countries in Southeast Asia, Latin America, and Europe rely on intermediate goods from China or export raw materials and agricultural products to both Beijing and Washington. Uncertainty in this trade relationship forces those nations to either absorb economic shocks or seek alternative trading arrangements, which can disrupt long-standing commercial patterns. Inflation is another concern. Higher import costs in the U.S. and China can translate into higher global prices for everyday goods, squeezing households far beyond their borders. In addition, multinational companies are increasingly reevaluating their production strategies, considering whether to diversify away from reliance on China or risk being caught in the middle of a prolonged standoff. This shift, sometimes described as decoupling, could fragment global supply chains, making trade less efficient and more costly. At the same time, developing countries may see both risks and opportunities, as they could attract new investment but also face instability in demand. Financial markets also watch these disputes closely, with each escalation or truce triggering movements in currencies, stocks, and bonds. Ultimately, the global economy is so interconnected that a U.S. China trade breakdown would not be isolated. It would affect growth, stability, and globalization itself. The 90-day pause may reduce immediate pressure, but it leaves unresolved questions that will continue to shape the world's economic future.